In this presentation, we will work a problem in Excel related to operating leverage. We're going to start off with a blank Excel sheet as we have here. I'm going to do a few things to it to start off. I'm going to make it a little bit larger. We'll bring it up to 140%, let's say. I'm going to highlight the entire worksheet and put a formatting for that entire worksheet by going to the Format Cells. And then we're going to make this currency, or this is what I usually default to, put brackets around it. We're going to remove the dollar sign, and I'm going to remove the decimals as the default, add them when necessary. And then say OK. We're going to be dealing with operating leverage. So I'll put that up top, operating leverage, and then we'll change this item to the cell style by going to the Home tab, the styles, and we're going to change the cell style over here to title. And then we're going to put the data that we will be using. So I'm just going to populate the data. Remember, when you're working with a problem, you typically want to put the data up top in the Excel worksheet so you can reference it with formulas so that you can make changes as easily as possible when working with Excel and see how those changes will automatically adjust for them. I've basically just populated the data here. I'm going to adjust it for you. So I'm going to open this up a bit so you can adjust this data here. We'll also have a pre-formatted worksheet that you can work if you don't want to do the formatting of this information as well. But when you see the problem in a problem, if it's in paragraph format, you want to break it out into some type of table like this. We'll put some brackets around it. I'm going to go to the Home tab and bracket this information. This is going to be a percentage. So I'm going to go to the Home tab, number, make it a percent. This is a percent. I'm going to go to the Home tab, number group, make it a percent. And then I'm going to make the entire thing bolded. So I'm going to select the entire item, the entire worksheet, and then go to the Home tab, font, and bold it. So there we have it. This is what we will be dealing with. We're going to be comparing company C and company D with the sales for C at $3,100,000. We have 60% profit margin. Fixed cost, $1,390,000 as compared to D, which has sales of $3,200,000, contribution margin 20%, fixed costs $150,000. We'll be dealing with operating leverage. We will use a calculation for the degree of operating leverage and see how that can apply with these two basic examples, with these two scenarios. We'll start off where we often do with a contribution margin income statement when we're thinking about CVP type of analysis, cost volume profit analysis. We're going to say contribution income statement for C and D. These are the two companies that we are comparing, of course, C and D. We're in the Home tab, alignment. I'm going to center this information. Then we're going to put down our normal stuff for a contribution margin type of income statement, which is going to be sales, variable costs, and then we've got the contribution margin, and then we've got fixed costs and net income. This is going to be our typical kind of contribution margin income statement, not the normal income statement, the one that's going to be easier for us to basically do projections with a contribution margin type income statement. Then we'll fill in what we have up top. Note they didn't give us the standard information. They're going to make us do some kind of funny work in order to figure out some missing information because we don't have the variable costs, in other words. So for C example, we have the sales amount, that's great, but we don't have the variable costs, okay? We do have the contribution margin percent. That's common to be done in practice problems. So we know that this number minus this number equals the contribution margin. We know the contribution margin percent is contribution margin divided by the sales amount. So therefore, we should be able to take this being equal to sales times the contribution margin, and that's going to be one of the major benefits of the contribution margin in the first place, to be able to have that percentage. And you want to be able to understand this relationship because you'll see this, any kind of algebraic problem related to the sales, the variable cost, the contribution margin, and the contribution margin ratio. They can remove any one of those items in any kind of problem, and we should be able to figure out the missing component. Going to be very common type of problem. So in other words, we of course took the 3,100,000 times the contribution margin, or 0.6, 60%, and that gives us the 1,860,000. Then we can figure out the variable costs because we know that the sales minus the variable costs is the contribution margin, and therefore the variable cost is the sales minus the contribution margin. So sales minus the contribution margin will be the variable cost. Again, we kind of have a problem that made us back into that information, but that's okay. And then we of course know that if we check this, 3,100,000 minus the 1,240 variable costs equals the contribution margin. If we took that contribution margin and divided it by 3,100,000, we get the 60%, which is this number here. So it all checks out. It all looks good. We're all ready to keep rolling forward. I'm going to do some formatting. We're going to format this by going to the Home tab, underline, and let's underline. And then we'll pick up the fixed costs and say that equals the 1,390,000, things like the rent, things that don't typically change. And then we'll subtract those out. This equals the contribution margin minus those fixed costs. That gives us the 470,000. Let's do some formatting. We'll underline here. We'll put a double underline there. And there we have it. Let's do the same thing for D now. This is our company D data. So we'll go down below and say, all right, D has sales of 3,200,000. D has variable costs we don't know yet, but we know the contribution margin percent. And therefore, we could say this equals the sales times the contribution margin percent. That'll give us the contribution margin. And then we can figure out the variable costs by saying that we know that sales minus variable costs equals the contribution margin. And therefore, variable costs equals sales minus the contribution margin. And that'll give us our 2,560,000. So we know that the 3... If we just double check that, again, it's probably good to double check these when we can. 3,200,000 minus 2,560,000. That's the 640. 640 divided by the sales. 3,200,000 is the 0.2 or the 20%. Checks out, looks good, moving forward. We're going to basically underline this, or we will underline that. No basically necessary. And then we're going to say that the fixed costs are the 150 in this case. There we have it. We can underline that. And then we're going to say net income is going to be the contribution margin minus the fixed costs. And we can underline that with a double underline. We can do some fancy formatting here and make it blue possibly, as we've been doing in the past. Just to keep it all the same, we'll make this black and white. Black and white. It's very black and white. Okay, so there we have that. And now we're going to take that, and now we're going to take this information and calculate the degree of operating leverage. Yes, this is the new thing. This is the thing we've all been waiting for here. So degree of operating leverage, this is going to be our headers that we'll have. We'll go ahead and center these for C and D, our two companies. We're going to say that the first item we're going to start off with is going to be the contribution margin, which we've calculated up top. So we'll just pick that one up. We're just going to say it's right there. It was right there. And I'll say that's for C and D. And then we're looking at net income. So I'll pick that up from up top. So here's our net income, and net income. And then we're going to have what we're looking for, which is the degree of operating leverage. And we could subtract, or we divide these items out to do that. So we're going to say this equals the contribution margin divided by the net income. And so I'd like to see some decimals for this particular number. So we're going to go up top, Home tab, Numbers. We're going to increase the decimals like so. Notice it's not a perfect world. We could increase decimals forever. You just have to deal with decimals. At some point, some way, some fashion, we take it out to the degree of decimals that is relevant to our decision making that we want to deal with. So we're going to say, all right, this number divided by this number, contribution margin minus net income for company D. Same thing. I'd like to see a few decimals because that one doesn't tell me much. So we're going to go to the Home tab, Number, and have a few decimal. Again, it goes on forever. We're going to take it out to 2 decimal places. Then we'll do our formatting to these items. So a little formatting. And there we go. Now, we might think, well, why would we want that? We might have a problem that asks for this, so we may want it for that reason. But and then why is this useful? So we'll look at some scenarios on why a calculation like this can be useful. To do that, let's consider what would happen if we had a 20% increase in sales. So let's say we're just thinking about this and say, well, what if there's, a 20% increase in sales? What would that do for company C and company D? Which one would be better off if there's a 20% increase in sales between D and C? Well, one way we can do that is to do the entire contribution margin income statement again with this increase in sales. So in other words, we could just say, let's copy this whole thing and bring it down. So this will be the header, except that now we're going to say that, let's call it a 20% increase in sales. And then I'm going to copy, let's copy the whole thing. I'll just copy this, put it down here, but then I'm going to delete the numbers. So in other words, if we did that one more time, we could copy the entire table, put that down here. And this is something you're often going to want to do. You know, when you're working with Excel, we want to limit the information that we have to put in there. I'm going to call this, what if there's a 20% increase in sales for the title? And then I'm just going to remove the numbers. And now we have all the formatting we needed. So now we're just going to do the same thing, except now we're going to consider what happens if there's a 20% increase in this line item. So we'll just pick up these numbers plus 20%. So in other words, we're going to start off with, we can calculate this a couple different ways. 3,100,000 times 0.2, that's the increase, plus the 3,120,000. Oh, let's get rid of 1 0, plus that. 3,720,000. Or we could, of course, say 3,100,000 times 1.2, 1.2 or 120%. And that'll give us that same number. We want the second calculation. It's faster, it's easier. We like the faster and easier method. So we're going to, in our formula, say this equals that number, sales times 1.2, 120%, 100 plus 20%. So we'll say there it is. And then the variable costs, because the variable costs act in the same way, we would expect if there's a 20% increase in sales, there to be a 20% increase in variable costs, because the relationship between the two should remain the same. That's the point of us breaking out variable and fixed costs. So 1,240,000 times 1.2, that's going to be the 1,488,000. So we will do that here. This equals the variable costs times 1.2. So times 1.2. And there we have that. And if we subtract these out, then we're going to say the sales or the contribution margin for C, if there was a 20% increase, is 2,232,000. Fixed costs remain the same. They're still here. No change there. And then the net income is going to be the 2,232,000 minus those fixed costs. And that's going to be the 842. So now let's do the same thing for company D. We're going to say this equals the sales times 1.2, 120%. That gives us the 3,840,000. Then variable costs equal the 2,560,000 times 1.2, or 3,072,000. Contribution margin then is the sales minus the variable costs. And then the fixed costs will remain the same. And then the net income is the contribution margin minus the fixed costs. The next thing we might want to consider is going to be the change in the net income. So the net income change, or the difference between the prior net income and the new net income, could be equal to, and I'm going to pick this one up first because this is the increase, so it's going to be a positive number. This is what we're at now minus what we had last time, 470, is a 372 increase. And then if we take for D, it's going to be the net income after the 20% increase minus the net income before the 20% increase. So there we have these items. This is our increase. And then we might want the percent increase. The percentage increase. And whenever we think about the percentage increase, we typically think about or take the change divided by the prior number. So that's going to be the percentage increase. In our case, of course, the 372, that's the change, divided by the prior number, the 470,000 0.79 or 79%. So if we do that here, we're going to say, all right, the change is going to be this equals the change percent, the percent increase is the change divided by the prior number. So there we have it. And then we can make this a percentage, home tab, numbers, percent. There we have it. Now note, it's not perfect. So we have rounding. We're always dealing with rounding. That's okay. And then we'll do the same thing for D. We've got the change divided by the prior number and enter. And then we'll make that a percentage. So and then we'll make this a little bit fancier. We'll highlight this, make it blue, put the grid lines. So we can see what we have here. The percentage increase for C is a 79% increase in net income when we had a 20% increase in sales. So C here has a much bigger increase in net income with the same increase in sales, while the company D only gets a 26% increase. Now you could say, well, I could see that in the numbers too. Why don't I just compare the numbers? Well, what if we're comparing companies of different sizes? We want to be able to also see the percentages and see what the effect on an increase in sales would be with relation to one company versus another company, even if their related income levels are much different. And we can do that with a percentage. We can say, okay, that's a big difference. If there's a 20% increase in sales because of the way this company C is laid out, how is it laid out? There's a big difference between the variable costs and the fixed costs. Fixed costs and variable costs. Because of that, the 20% increase in sales here, mainly because there's a lot more fixed costs, right, results in a 79% increase in a percentage increase, whereas a percentage increase in net income. Whereas this one, because there's much less fixed costs, the increase in sales also increased the variable costs a lot, and therefore there's only a 26% increase. So you can see how this calculation would basically work. How can we do this a bit easier? How can we do this with the degree of operating leverage? That's what we'll do now. So we're going to pick up the degree of operating leverage. Our end calculation is going to be the percent increase again. We're just going to do this with our new basically number, our new calculation number, which is going to be the degree of operating leverage. So I'm going to say that's what we calculated up top, this number. So that's going to be what we're dealing with first. We're going to say this equals the degree of operating leverage, which is this number. You can't just hard code it, because if you do, it's not exact. Remember, it's not really 4, obviously. It's not really even 3.96. It's really something larger than that. So if you just typed in 3.96, then it's going to be slightly different than what we will calculate here because of rounding. And then we're going to say, all right, D had 1.31. Let's add some decimals there. So we'll add some decimals. And then we have the percent increase in sales. So the percent increase in sales was the 20%. We're saying there's a 20% increase. I'm actually going to hard code that. So 20% and 20%. Now I put a 0.2. I'm going to now format this as a percentage. So I'm going to go to the home tab, numbers. Again, if I add decimals, there's the 0.2, and then make it a percent, moves the decimal 2 places to the right and adds a percentage sign. We'll then underline this item, and then we're going to have the percent increase in income. So the percent increase in income is then going to be equal to the 3.96 times the 20%. And notice how nicely we get that. We get to get this number here, and we're going to make it a percentage. Once again, home tab, number, there's the decimals, here's the percentage. And it's not exact. If I add more decimals, it's not exact. We'll keep it here. We'll do the same thing with this item. This equals the 1.31 times the 20%. And then we will go to the home tab, numbers. We're going to add decimals. There it is. And then make it a percent. There's the percentage, same numbers as we can see. So note, we could do this basically much quicker calculation and start to think about, okay, what would happen if there's a percentage increase in sales? What would be the percentage increase in the net sales? So if there's a percentage increase in the top line number, what would be the percentage increase in the net income, the bottom line number? So I'm going to go ahead and format this for us. We'll make it blue. We'll put some grid lines in it, and we'll make this black and white like so.